Hello guys, good day. Welcome to another video lecture in ACC 311 Income Taxation. In this video lecture, we will be discussing another procedures in computing for the taxable income and the tax due, assuming this time that our taxpayers are partnership and partners. Okay, let us begin our discussion by defining what is a partnership. When we talk about partnership, it is a contract of two or more persons bind themselves to contribute money, property, or industry to a common fund with the intention of dividing the profits among themselves. So again, when we talk about partnership, it's a group of people combining their resources to create and having an intention of, again, forming an entity to derive an income. So partnership is being classified into two. We have GPP and GCP. General Professional Partnership, or GPP, is one formed by persons for the sole purpose of exercising their profession, no part of the income of which is derived from engaging in any trade or business. So from the term itself, general professional partnership, so these are partnership that is related in discharging services or discharging professional services. So example of general professional partnership are accounting firms, partnership of CPAs or law firms, the partnership of lawyers or engineering firms, or any other professionals that is, again, forming a partnership with the purpose of providing professional services to the public. But again, it shall only be recognized as professional partnership when no part of the income is derived from engaging in any trade or business. So that is GPP. We also have here General Co-Partnership, guys, or GCP, or it is popularly known as Compañía Colectiva. It is a partnership or a general partnership which is not considered as a general professional partnership. So again, it has a residual definition. It considers a residual definition of a partnership. So as long as it is not a general professional partnership, then therefore it will be considered as a general co-partnership. So again, we need to properly distinguish the type of partnership because these partnership differs in their taxability. We will be having separate tax rules pertaining to a general professional partnership, and we will also have separate rules pertaining and will be applied to general co-partnership. So again, in the first place, before accounting for the taxable income and tax due of this partnership, the first thing that we need to do is to identify whether this partnership is a general professional partnership or a general co-partnership. Okay, so let's proceed with the tax liability of these types of partners or partnership. So again, guys, our taxpayers here will be the partnership and the partners. So it's just a summary on the tax liabilities of both the taxpayer, whether it's the partnership or the partners. So the details of this will be discussed in our as we progress with our video lecture. So when the partnership is a general professional partnership, guys, the partnership is itself is exempted. Okay? It is not subject to income tax. Okay? GPP is not subject to income tax imposed pursuant to Section 26 of the Tax Code as amended. However, the partners shall be liable to pay income tax on their separate and individual capacities for their respective distributive share in the net income of a general professional partnership. So, the partnership itself is exempted. However, any share of the partners from the distributable net income of this general professional partnership will be subjected to basic tax on the income tax return of the partners. Okay? The partnership itself is exempt. However, the share of the partners of a general professional partnership is subject to basic tax. Okay? The reason of a general professional partnership for exempting it because the GPP is considered only as pass through where the entity's income is again only ultimately taxed to the partners comprising it. So that is why the general professional partnership is not subject to income tax. Okay? Because it is just simply considered as pass through. Because again, the income of the partnership will be returnable or will be subject to tax on the partners. Okay? But when the partnership is a general co-partnership, guys, so meaning the revenues or the net income of this partnership is again coming from the operation of business, not from practice of profession, so it will be considered as if it is a corporation. So again, since it is considered as if it is a corporation, so therefore any net income of the general co-partnership will be subjected to 30% corporate income tax, while any share of the partners from the distributable net income of a general co-partnership will also be subjected to 10% final tax. Okay? As if it is a dividend received by an individual from a domestic corporation. So again, it is subject to 10%. So 10% if the taxpayer or the partner is resident citizen, resident alien, or non-resident citizen. 20% if the taxpayer or the partner is non-resident alien engaged to trade in business. And then 25% if the partner is a non-resident alien not engaged to trade in business. So again, this is the summary on the taxability of the partnership and the partners when the tax or when the partnership is a general professional partnership and a general co-partnership. This time, let us proceed with specific um, discussion of these types of partnership. So we have here general professional partnership, guys. Again, liability of partners in a general professional partnership. Persons engaging in business as partners in a general professional partnership shall be liable for income tax only in their separate and individual capacities. So as what I have mentioned earlier, any share from a general professional partnership will be subject to basic tax. General professional partnership is required to file return. Again, guys, although the GPP is exempt from paying income tax, but still they are required to submit income tax return. Okay? Every general professional partnership shall file for the purpose of monitoring. Okay? Shall file in duplicate a return of its income exempt under the tax code, setting forth the items of gross income and deductions and the names, the tax identification number, addresses, and share of each of the partners. Okay? While the manner of computing for the net income of a general professional partnership, guys, is the same with the manner on how are we going to compute for the taxable income of the partnership of a corporation. Okay? For the purposes of computing the distributive share of the partners, the net income of a general professional partnership shall be computed in the same manner as a corporation. Okay? Same as if it is a corporation. Basis of the income which a partner will report. So how much will be reported as part of the gross income of the partner. So each partner shall report as gross income his distributive share, actually or constructively received in the net income of the partnership. Okay, so whatever is the share ni partner from the partnership distributable income, that will form part as the gross income of the partner. Okay? Additional points that we need to consider in general professional partnership, partner's distributive share forms part of his gross income, as what we mentioned earlier, subject to graduated income tax rates. Okay, guys, let me make it clear that when the sole source of income of the partner is only the income from the partnership, which is a general professional partnership, then therefore that income, guys, will only be taxed using the graduated income tax rates. Okay? It shall only be graduated income tax rates ang pwedeng gamitin ni taxpayer. Dili siya pwede mo gamit og 8% nga income tax. Again, for what reason? For the reason of, again, for the reason of the distributable share that the partner has received, or the net income distributable of the partnership is already net of cost and expenses. Okay? So that is why it is no longer subject to 8%. Because let me remind you guys, if the individual is using 8%, our basis sa 8% will be the gross sales. So in this case, the distributable net income of the partnership is already net of cost or any expenses. So that is why si partner, if ang sole source of its income is only this share niya from a general professional partnership, then therefore it will only be taxed using the graduated income tax rates. Okay? And again, GPP is not a taxable entity because it is only acting as a pass-through entity where its income is ultimately passed to the partners, as mentioned earlier. But GPP may still avail of either itemized deductions or optional standard deduction, then distribute net income to the partners. So just like with your individual taxpayers or your corporation, si partnership also, particularly general professional partnership, can use itemized deduction or optional standard deduction in computing for the net income to be distributed to the partners. However, if the GPP avails of either itemized deduction or OSD, the partners cannot claim any further deductions and may not avail the 8% tax because the distributive share is already net of cost and expenses, as mentioned earlier. However, again, if the partner derives any income from other sources other than the share in GPP, he may still claim either itemized or optional standard deduction from other sources of income. So for example, aside from the share of the net income in the partnership, let us say the partner has a separate business, okay? In that separate business, guys, that partner can still use either itemized deduction or optional standard deduction. Okay? So, meaning the partnership itself can use itemized or OSD, and then on its separate business, on its independent business, the partner can still use either itemized deduction or OSD as well. Okay? That is from RR 818. Okay, so you can actually search that on internet or browse that from the BIR website, see full digest of RR Revenue Regulation 8 series of 2018. Or I will be um, giving the link below, guys, to again to browse that specific RR. Now, we have here illustration. Mr. GMLH, for example, is a partner of AMBS in company, a general professional partnership, and owns 25% interest. The gross receipts of AMBS and company amounted to 10 million for taxable year 2018. The recorded cost of service and operating expenses of AMBS and company were 2,750,000 and 1.5 million respectively. Now, assuming that AMBS and company availed of the OSD, the deductions and the net income shall be computed as follows. So again, guys, here we have GMLH partner, AMBS and company, a general professional partnership. So again, this is a general professional partnership. Therefore, it will not be subject to income tax. So again, to compute for the net income for distribution, to the partners, we'll just simply compute for the gross income. So that's from gross receipts of 10 million less cost of sales of 2,750,000 less gross income, to compute for the gross income of 7,250,000. So in this case, guys, it's the assumption that the partnership used the optional standard deduction. So again, optional standard deduction will be applied the same sa rules on optional standard deduction doon kay corporation. So again, it will be based on the gross income multiplied by 40%. So in this case, we have a total gross income of 7,250,000. Multiply it by 40%. So we have a total optional standard deduction of 4.9 million. So therefore, the net income for distribution, guys, of the partnership will be 4,350,000. So this 4,350,000 will no longer be reduced by 30% income tax rate since again the partnership is a GPP. Okay? The partnership is general professional partnership. So that means we will no longer be reducing this 4,350,000 for 30%. So this exact 4,350,000 will be distributed to the partners. Okay? To continue, so given in the illustration that the partner will receive 25% of the total distributable or distributable income of the partnership. So that means 4,350,000 times 25%. So share ni partner will be 1,805,500. And again, as mentioned earlier, any share of a partner from a GPP net income will be again subject to basic tax. And in this case, guys, no other income man siya. So that means it can only be taxed using the graduated tax rates. Okay? So we have for the first 800,000, so this 1,807,500 belongs to 800,000 to 2 million. So for the first 800,000, so it has a tax due of 130 and excess. So it has an excess of 1,007,500 times 30%. So we have 86,250. So we have 216,250 total tax due of the partner. Okay? It will be returnable sa partner, meaning it will be reflected on the income tax return of the partner. Okay? Now, take note that although GPP is exempt from income tax, but GPP is subject to business tax. But as to the liability in terms of business tax, so you will discuss that, guys, in your business tax subject. But our objective lang this time is to compute for the income tax. Okay? We are only limited muna kay income tax. And also, again, remember, taxpayer will not be allowed to avail of the 8% income tax rate option since, again nga, their distributive share is already net of cost and expenses. So again, so kung wala nang ibang source of income si partner, then therefore, his tax due will be 216,250. Okay? Now, what if the taxpayer opted to use itemized deductions? So again, same procedure. We will just simply compute for the distributable share of the partnership and then distribute this share sa mga partners based on their stipulated agreement on their articles of partnership. But in this case, we will use the itemized expenses. So assuming that there is an operating expenses of 1.5 million, so therefore, instead of using 40% of the gross income, we will use operating expenses here of 1.5 million. So that gives us a net income for distribution of 5,750,000. So again, same rule earlier. this 5,750 will be distributed sa mga partners. So assumption, Jill shares 25%. So si Jill will be receiving 1,437,500. And again, it will be taxed using the tax table. So it belongs to, again, kay 800,000 to 2 million. So for the first 800,000, it will be subject to 130, and then ang excess niya will be 647,500 times 30%. So we have 191,250. So total tax due of Miss Jill will be 321,250. Okay? Now, what if there are other expenses which are not liquidated by the partnership but are again incurred by the partners? Okay? So, what will be our rule if there are expenses which are part of the operation of the partnership but wasn't able to be included in computing for the distributable income of the partnership, pero it was incurred by the partners? So again, guys, the rule there, if there are unliquidated expenses that is incurred by the partners, which are again should be part of the operating expenses, so such expenses, such unliquidated expenses of the partnership incurred by the partners will be or can be claimed as deduction in computing for the taxable income of the partners. Okay, that can be claimed as an allowable deduction on the computation of the taxable income doon kay partners. Pero only if the option of the partnership is itemized. Okay? It's only if the option, guys, is only if the option is from itemized. Meaning, kung ang gigamit ni partnership, guys, in claiming its allowable deduction is OSD, then that means any unliquidated expenses incurred by the partners can no longer be claimed on their income tax return, because again, when we talk about optional standard deduction, OSD is already in lieu of all itemized deductions. So again, the partner can only deduct on their income tax return all the unliquidated operating expenses of the partnership when the partnership uses itemized deductions. Okay? Okay, we have here an illustration for the taxable year 2019, Jaja and Dindin. Partners of a general professional partnership agreed to divide profits and losses for 50-50. Both are married without qualified dependents. The following are the details of the account. So we have the sale of service of the general professional partnership for 2.5 million. Cost of services of that GPP, 875,000, and their itemized deductions of 825,000. Okay? It also discloses the separate expenses and other sources of income of both partners. So it has traveling expenses which are not liquidated in the general professional partnership, guys. Again, it also has representation expenses using the personal credit card of the partner. But again, these are representation expenses which should be which should be included as expenses of the partnership but was not able to be included as part of its expenses, and their cost of car, which is to be depreciated over 5 years and are used in the practice but are registered under the partner. So again, although it is registered under the name of the partners, but since these cars are used in the practice, then therefore it should also be part of your itemized deductions. Okay, the tax code, guys, clearly gave examples of the expenses that can be claimed when it is not disbursed or reimbursed by the partnership. Example of these are the representation expenses incurred by the partner, where the covering invoice or receipt is issued in his name, but again, it is part of the business operation. Traveling expenses while away from home, which were not liquidated by the partnership, and depreciation of a car used in the practice of profession where said car is registered in the name of the partner, and any other similar expenses. So that means all of these unliquidated expenses of the partnership, which are again incurred by partners, can be claimed. Again, can be claimed as a deduction on their income tax return. But again, meron tayong rule. When the partnership uses optional standard deduction, these unliquidated expenses cannot be claimed as deduction by the partner. It's only when the partnership uses itemized deduction. Okay? And aside from that, they also earn salaries from JPP, 360 and 300 respectively for Jaja and Dindin. They also derive lotto winnings of 900,000. Nakadaog si Jaja ng lotto for 900,000. Interest on bank deposit, guys. Do you still remember the rules on passive income for our individual taxpayers? So lotto winnings, since it's more than 10,000, it will be subject to 20%. Interest on bank deposit, so it's passive income subject to 20% final tax, 25 and 20. And then this is book royalties, guys. Book royalties. Book royalties ni Dindin that is subject to 10%. Okay? So that's 250,000. That will be subject to 20 book 10% kapag books. Okay. So let us compute for the distributable net income of the general professional partnership and at the same time the share of each partner. Okay, so we have here two assumptions, assuming the partnership opted to use OSD and the partnership opted to use itemized. So again, guys, we just simply based it with our gross income. So gross income times 40%, so we have 650. And then itemized, guys, as mentioned earlier, we have a total itemized deductions of 825,000. So excluding ito yung mga unliquidated expenses. So that means if the partnership opted to use OSD, then it has a distributable net income of 975. And if it's itemized, there will be a distributable net income of 800,000. So the share of each partner under OSD will be 487,500, and for itemized, there will be 400,000 na this share ni partners. So again, guys, these share of the partnership, since the partnership is a general professional partnership, will be subjected to basic tax. Okay, so let's continue. We have here the computation of the taxable income of each partner. So again, guys, still on two circumstance when the partnership opted to use OSD and itemized. So as computed earlier, guys, we have a share for each partner under OSD na 487,500 each and under itemized deduction of 400,000. So let's compute muna the taxable income of the part of each partner if the partnership opted to use optional standard deduction. So again, since the partnership uses OSD in computing for its distributable net income, so that means the mentioned unliquidated expenses earlier, guys, cannot be claimed or cannot be deducted anymore in computing for its taxable income. Because again, the OSD or the 40% already stands for all the itemized expenses, regardless if there are expenses which were not liquidated. So that means the total share of each partner in a general professional partnership under OSD will be still for 87,500. You add their salaries of both partners. So we have 360 and 300 respectively. Okay, we have 360 and 300 respectively. So therefore, we have a taxable income for Jaja na 847,500 and for Din of 787,500. Okay? So needless to say guys, yung lotto winnings, interest on bank deposits, and book royalties cannot be included in the computation of the taxable income since those income were taxed already. Okay? They are already taxed at source. So in this case, let's proceed. What if the partnership uses itemized? So in this case, the unliquidated expenses can be claimed. Okay? Can be claimed. So from the share of the partnership, net income of 400 each. So you deduct the unliquidated expenses. Okay, we have traveling expenses of 34.5 and so on for Jaja and Dindin. And then we have depreciation of car, guys. So take note that what will be deducted is only the depreciation that is covered for that particular taxable year. Okay, so you need to depreciate that car. So only the depreciation for that year can be claimed. So that means we have a total share in the partnership net income of 201,250 and then 244,000. Add salaries from the GPP. So we have 561,250 and 544,000 as our taxable income. Okay? So this taxable income guys will be taxed using the tax table because first ang share ni net income sa partnership is already net of cost and expenses, and at the same time your salaries, okay, your compensation or your salaries cannot be taxed using 8% as well. So therefore these are combination of income which can be taxed only using by graduated income tax rates. Okay. So, kayo na mag-compute guys kung magkano ang tax due ni Jaja, ni Dindin under OSD and under itemized deduction. Okay? You just simply refer it to the tax table in computing for their respective tax due. Now, let's continue the illustration. So what if Jaja has income from business other than that of the partnership and has the following data. So for example daw si Jaja, aside from the net income in the general professional partnership, it has other separate na business also. So again, general rule, if the partner has other business income other than that of the partnership, then the partner can still use no either optional standard deduction or itemized deduction. Okay? So we have here, for example, we have gross sales of 5 million, sales returns and allowances of 20, sales discounts of 225, cost of goods sold manufactured and sold for 1.5 million, and itemized expenses of 980,000. So in this case, we assume that the Jaja will use itemized expenses, and then again, he will opt to tax its business income using the graduated tax rates because si Jaja can also opt to tax this income niya from business at 8%. Okay? So, pwede si Jaja mo-opt og 8% aning income niya sa business. Pero, ang income niya sa partnership profit dili pwede i-tax at 8%. And obviously, ang salaries pud niya for whatever work he may have, dili or she may have, dili pud niya pwede i-tax at 8%. Okay? So here for discussion purposes, let us assume that si Jaja opted to be deducted the itemized expenses and it uses to be taxed at graduated tax rates. So we have here the taxable business income guys of 2,275,000. So just the same on how did we compute business income from an individual taxpayer before, and then add, so atong assumption diri guys kay ang partnership naggamit og itemized deduction also. So assumption lang nato ha that the partnership uses itemized deduction. So from our computation earlier, okay? So itemized man daw, so si Jaja, itemized, this is our assumption. So that means ang share daw ni Jaja from that partnership is 201,250 plus ang ihang salaries of the GPP nga 360. So we have 561,250 plus the taxable business income of 2,275. So therefore, your total taxable income ni Jaja for that year, including all of its income, is 2,836,250. Okay? To compute it, so you simply based on the tax table, so we have 2 million for 90 and excess of 2 million, we have 836,250 times 32%, so we have 267,600. So we have a total tax due of 757,600. Okay? So those are the things that you need to remember, familiarize, and master when the partnership is a general professional partnership. Okay? Now this time let's proceed. What if it's a general co-partnership? So again guys, based on the summary that we had in the first on the third slide, no? When it's actually a general co-partnership, the partnership itself is subject to tax as if it is a corporation. So therefore, the general co-partnership will be subjected to 30% corporate income tax rate. And then at the same time, any share of any partner sa distributable net income of that general co-partnership can or will be subjected to 10% final tax if the taxpayer is resident citizen, non-resident citizen, or resident alien. 20% if the partner is 20% if the partner is non-resident alien, engaged to trade in business and so on. Okay? Now, we have here the important points to remember pag general co-partnership. So, taxable partnership are required to file cumulative declaration and annual return. So, as if it is a corporation nga. So, the corporation rules will be applied kay general co-partnership. So, there will also be a submission and payment of income tax every quarter. Okay? And share of partner, again, as mentioned earlier, will be subjected to final tax. Okay, ito na yon. 10% kapag RC, NRC, and RA, and then 20% is NRA, ETB. And then, the partnership itself is subject to 30% corporate income tax. And I'd like you to note this, guys. If the partnership sustains a net operating loss, that means the expenses of the partnership is higher than the total gross income that it generates. So that operating loss, guys, the partners shall be entitled to deduct their respective shares in the net operating loss from their respective shares in the net operating loss from their individual gross income. So for example, let us say there's a gross loss of 100,000. Okay? Or net operating loss of 100,000. And let's say we have partners A and B sharing 50% equally for any gain or loss. So, that 50,000 guys nga share nila both of the operating loss can be deducted. Okay? Pwede siya i-claim as deduction in computing for the taxable income nila as an individual. Okay? In their return if ever there is an operating loss. Okay, so we have here an illustration. Kiana, single, is a partner in KM partnership, a general co-partnership. Kiana derived income from her profession as auditor. It is agreed upon that partner Kiana is to receive 60% share in the profit and loss of KM partnership, while partner Mark will receive 40%. Compute for the taxable income, regular income tax due, and final tax of Kiana using the following data. Okay? Okay. So we have gross income of KM partnership na 3.5 million, gross income of Kiana from profession of 800, income tax withheld on professional income, guys, na 20,000. So as we all know, this tax withheld na 20,000 is considered as a tax credit when we will be computing for the tax payable later on, and then expenses of KM partnership of 1.2, and then expenses of Kiana in profession of 130, and in her practice of profession for 130,000. So again guys, as we all know, the partnership is subject to 30%. So that means in computing for the distributable net income, we need to deduct first the income tax of the partnership before we could compute for the distributable income or the net income after tax. So we have here the gross income of 3.5 million. Okay, gross income of 3.5 million less partnership expenses of 1.2. So that means the net income before income tax of the partnership is 2.3 million. So reduce it by 30% kay tax due man nimo, you will be paying that. The corporation or the partnership construed as a corporation will be paying that income tax due. So we have 2.3 times 30%, so we have 690. So therefore, the amount to be distributable to Kiana and Mark will be 1,610,000. Okay? 1,610,000. So to illustrate further, so the taxable income, regular income tax, and final tax due of partner Kiana will be, so Kiana will be sharing 60% of the total net income. So the total net income after tax or the distributable income of the general co-partnership was 1,610,000. Multiply it by the share of Kiana in the KM partnership. So we have 1,610 times 60%. So that's 966. So this share of the distributable net income of Kiana is subject to 10%. So general rule, if the problem is silent as to the classification ni taxpayer, our assumption will be resident citizen. Okay? Resident citizen. So that is why it will be subjected to 10%. Unless the problem is vocal, no? Or implicitly stated niya sa problem kung anong classification ni taxpayer. So in this case, there is a final tax on the point of view of Kiana na 96,600. So again, what will be received by Kiana will already be after of 96,600. Okay? Now, speaking of regular income tax, si Kiana ano, has also a practice of profession aside from its general co-partnership. So again, guys, that income of Kiana from practice of profession is also subject to tax. So we have here 800 minus 130 na expenses, so we have 1,610,000. So assuming that Kiana opted to use the tax table in computing for its tax due diri sa iyahang income sa profession from her income from profession. So ang tax due niya, guys, will be 1,610,000 from 800 to 2 million. So that's 800, 130,000 for the first 800,000. And then in excess, we have 810 times 30%. So we have 243,000. So ang total taxable income, total income tax due ni, guys, ni Kiana will be 373,000 if again Kiana opted to use the tax table. Pero take note, si Kiana is also allowed to use 8% tax rate para aning income niya from practice of profession. So same nato nga rules nga gi-discuss in our discussion sa 8% income tax option. Okay? So again, pwede siya mogamit og 8%, pwede siya mogamit og graduated tax table in her income from profession. Pero itong 96,600 will no longer be included as part of its taxable income kasi nga it's already taxed at 10%. Okay? It's already taxed at 10%. Now, last is co-ownership, guys. So, what if there is a co-ownership? What is the tax implication if there is a co-ownership? When a co-ownership is present, a co-ownership shall not be subject to income tax if the activities of the co-owners are limited to the preservation of the property and the collection of the income therefrom. Such being the case, it is the co-owners who will be taxed individually on their distributive share in the income of the co-ownership. So again, guys, if there is a co-ownership, it is not the co-ownership will be taxed, but rather it is the co-owners ang taxable on whatever share they may derive from the net profit of the co-ownership. But should the co-owners invest the income in business for profit, they would be constituting themselves into a partnership and as such will be taxable as a corporation. So as if they ventured into a general co-partnership. So therefore, they will now be taxed as if they are a corporation. Okay? So that's for co-ownership. So basically, that would be the procedures that we need to master when our taxpayer guys is a partnership or a co-ownership. Just a sort of recap again from our summary. When the partner is when the partnership is general professional partnership, the partnership is exempt, but any share of the net income derived by the partner is subject to 10% final tax if they are resident citizen, non-resident citizen, and resident alien. And then 20% kapag non-resident alien engaged to trade in business. However, if the partnership is general co-partnership, so there will be double taxation in general co-partnership because the partnership itself is subject to 30% regular corporate income tax, and then any share of that net income to be distributed sa mga partners will also be subjected to ano 10% final tax. Sorry, my bad. Um, Kapag GPP, ang share ni partnership, ang share ni partners is basic tax. Okay, basic tax. My bad. Basic tax. Pero ang share ni partners sa general co-partnership, yun ang 10% na subject to yun ang 10% subject to final tax. Okay? So I hope that that is clear. Guys, I hope that that's clear and we had learned something from our video lecture for today. So, I think that would be the end of our video lecture. So, if you have queries or clarification for the matter discussed, you may ask that on the comment section below, or you may PM me or message me sa atong group chat, or reserve it to be asked on our virtual class. Okay? So I hope that everyone is well and keep safe, everyone. Thank you for listening and God bless.